You're watching episode 33 of the Tax Smart Daily, a daily video series for real estate investors to get tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Tax Smart Facebook group and the Tax Smart newsletter. Links to both of those are in the description of this video. Today's topic is allocating purchase price between land and improvements whenever you purchase a rental property. Now, first, why do we even have to do that? Well, the main reason is that when I purchase rental property, I can depreciate the improvements, the building, the 5-year property, 15-year property, and then that 27.5-year property. I can depreciate that over time. And so I pay for the asset up front, and then I get to take a small deduction for some period of time, typically 27.5 years, especially when we're talking about a rental building. But the problem is when I purchase a property, I don't just purchase the building and all of its components. I also purchase the land, in most cases, the land that it sits on. So I have to allocate some amount of the purchase price to the land value because land is not a depreciable asset. So when I buy a property for $100,000, I might allocate $12,000 to land, and then I would depreciate the remaining $88,000 over 27.5 years. So I've got to make this allocation up front. Now the question is, how do we determine that allocation? So I just pulled a random 12% out of nowhere. And where did I get that information? Well, you have to use a reasonable method to determine the land value. So you can't just come up with random numbers. A lot of tax practitioners make the mistake, probably unknowingly, and they use a random 10% or 15% number across all rentals that they prepare tax returns for. We've seen this many times. The problem with this approach is that if you are audited, ultimately you're responsible as a taxpayer for whatever ends up on your tax returns. If you're audited by the IRS and they ask you, how did you determine that the land value is 10% and you've got nothing, no evidence, no substantiation, you don't have a reasonable basis for using a 10% value. You have put yourself at the mercy of the IRS. They can determine however they can substantiate whatever that land value should be. The issue is that they're going to say land should be higher value rather than lower value. Why would they do that? Because let's go back to my $100,000 example. If I'm depreciating 88% of the value, $88,000, that's a good amount of depreciation that I'm going to get to claim every single year for 27.5 years. But if the IRS came in and said, hey, your land value should actually be 40%, now I can only depreciate $60,000 over 27.5 years. I've lost $28,000 of depreciation. That probably cost me about $1,000 a year for 27.5 years. So you don't want to put yourself at the mercy of the IRS. You want to have some evidence, some substantiation as to why you used the method that you used and how you determined the ratio that you used to allocate value between improvements and land. Now, there are three main ways to do this. There are several ways to do this, but there are three main ones that we have seen in practice. The first is that you actually put it in the sales or purchase contract. So if you're purchasing the property, you and the seller are agreeing to a land versus improvements valuation. Or if you're selling, you and the buyer are agreeing to this valuation. Now, I'm not going to get into all the technicalities with that. Buyers are going to be at odds with sellers with how they value things. Buyers want larger depreciation deductions. Sellers want to allocate value away from their prior bonus depreciation deductions, their 1245 assets. So they're going to not want to allocate value towards those assets. So you've got some issues that you have to work out, but you could put it in the sales contract. We sometimes we don't see this often, but we sometimes see this with larger assets, like really large assets. We'll see this happen, but on smaller assets, we typically don't see anything in the sales contract itself. The second way to do this is to use an appraisal. So you have a qualified appraiser go out, appraise the value of improvements in land. Now, most appraisers don't actually appraise the land value. So you would have to double check with your, however your appraisers do it in your local area, and see if you can get some sort of land comp built in there as well. That might help drive that valuation. The third and most popular way, but also the way that the IRS prefers not to use unless there's no other clear way to get to the valuation of the land. The third way, and again, the most popular way, is to use the property assessor database or property tax card. So all of your rental properties and all real estate properties are logged publicly, except I learned recently that Texas, you can't actually get this information very easily in Texas because of their confidentiality rules, which is really interesting. But most states have online databases that you can access, and you can look up whoever you want, whatever address you want, and you can see the improvement assessment and the land assessment. I've actually used this to look up the name of my neighbors because I'm really bad at remembering names. So I'll go and like meet somebody and then be like, oh, I forgot who you are. So I'll go look you up on the property tax assessor website, and then there you are, and I remember your name. Anyway, so but when you purchase rental real estate, if I purchase 123 Main Ave, I can go into the county assessor's website, pull up 123 Main Ave, and I can see the last assessment for improvements and land. So if improvements were $80,000 and land was $20,000, then I have an 80% ratio to improvements, a 20% value to land. And then I would apply that ratio, that 80-20, to whatever my purchase price is. So my purchase price might be $500,000, might be $1 million. If it's $1 million, I'm allocating $800,000 to improvements, $20,000 to land. So you use whatever that ratio is, and you apply it to your purchase price to ultimately determine what value is going to be allocated to your improvements, what value is going to be allocated to your land. Now, in 2017, there was a tax court case out in the taxpayer bought property out in Los Angeles, and the taxpayer allocated 100% of the purchase price to improvements, and they were depreciating 100% of the purchase price. Now, if you scroll back 3 minutes here, you know that you can't do that because you got to allocate some amount to land. The taxpayer in this case allocated nothing to land. The IRS went and pulled the property assessor cards and reallocated the value to land, and they had like about, I think it was like 35 to 40% value allocated to land, and the tax court sided with the IRS. So we know that even though this is a method, the property tax card is a method that the IRS prefers that you don't use, as long as there's other better evidence like a qualified appraisal, they will use that. So we know that this is sort of like a safe harbor, something that we can use to substantiate some allocation, and it's way better than just pulling some random number like 10% or 15% out of where. I actually wrote an article about this on taxsmartinvestors.com. It's our new premium content website. You get a weekly tax strategy newsletter, and you get access to tools, investor tools, webinars that we've done in the past, and we're going to keep adding content to that website, but it's a little bit more technical than this, cited. It's got the regulations, the code, and tax court cases all there, and we're kind of like breaking things down. So if you're interested in some more technical analysis and understanding, then go check that website out. That's taxsmartinvestors.com. And you can get a 14-day free trial, so you'll get at least 2 tax strategy newsletters before you have to decide if you want to continue paying or start paying that monthly fee of $25. So relatively cheap to get really good tax advice. Thanks so much for watching this episode of the Tax Smart Daily. I hope that you're having an awesome week. Join us online in our various communities. You can check out our links below in the description of this video. We'd love to see you follow us online and be part of our overall network.